When markets are volatile, rising interest rates, inflation worries, or a big downturn, having some cash parked in safe places is very smart. But traditional savings accounts often have pathetic yields, and money market funds are just okay these days. And that's why people are pushing more cash into short term treasury bond funds, ultra short term duration fixed income, and cash sweep accounts. Today, we're going to be looking at three ETFs where you can store your cash, which is basically going to be risk free. And the first one, of course, is going to be SGOV. I know a lot of you are familiar with this ETF. It's one of the more popular options out there for a short term treasury bond ETF, which is virtually risk free. It's the iShares 0 to 3 month treasury bond ETF, and it has about $57 billion assets under management. Now, if you take a look at iShares' ETF website, we can see it has an expense ratio of 0.09%. So it's fairly low, and it does have a 3-star Morningstar rating because it is a very low yielding ETF, not designed to grow and make you wealthy, but designed to preserve your capital. So we take a look at the investment objective. We can see it seeks to track the investment results of an index composed of US Treasury bonds with remaining maturities less than or equal to 3 months. And why SGOV? So you're getting exposure to the US Treasury bonds with remaining maturities less than or equal to 3 months, as we mentioned earlier, the objective, and you're getting targeted access to a specific segment of the US Treasury market, which is going to be the very short term treasuries. And number 3 is probably the most important one, which is going to be seeking stability in your portfolio and putting your cash to work. Now, I know a lot of you love high yielding income ETFs, but you probably have an emergency fund or you're setting aside money for taxes, and you do want that money to work for you, even if you don't want any risk. And in my opinion, SGOV is one of the best options out there. It simplifies buying treasuries. If you've ever bought a treasury bond from the US government, it could be quite lengthy and a little bit complicated. And with this ETF, it simplifies everything for an expense ratio of only 0.09%. You don't have to manage any of those short term treasury bonds. It's simply an ETF you can buy and sell on the stock exchange. Now, if we take a look at the chart of SGOV, we can see that it does have some ups and downs, and a lot of people in the comments have been quite confused about this. They claim that they have lost money from this ETF, but that's not necessarily the case. But first, let's go into the distributions. We can actually see it has about a little over 4% dividend yield, and it pays out every single month. If you take a look at the cash amount, you're going to be getting about 36 cents per share. So if you have 100 shares or $10,000 in SGOV, you're pretty much getting between $30 and $40 every single month, as long as the interest rates stay the same. Now, that could change, obviously, but for now, we're going off of this 4% yield. And while this ETF isn't particularly designed to make you rich, it's quite interesting that it actually has outperformed SCHD, because SCHD in the past 4 years has not really been doing too well, and it only has a dividend yield of less than 4%. So a lot of people have not been too happy with SCHD as of lately, and SGOV surprisingly has outperformed in the past 3 years or so. And I did have a video where I put my entire emergency fund into SGOV because it had one of the best yields. It's very simple to buy, and it's virtually risk-free. And a lot of people are asking, how safe exactly is SGOV? So the basic question, how safe is SGOV compared to a CD or money market accounts, which are all very safe investment options? And a lot of comments, there's virtually nothing safer because it's investing in treasury bonds. So the only way you're basically losing money is if the interest rates severely drop in a short period of time, or if the US, of course, defaults. We have another comment here. SGOV holds the US Treasury bonds. It's as safe as anything you can get. And this comment right here, it's not a money market fund, so it does not maintain dollar parity. but it does invest in similar assets as those money market funds with a similar weighted average maturity. And it is possible to lose money, and that is going to be by buying the fund, seeing a significant interest rate increase, and then selling the fund on a short time scale, 1 to 3 months. Simply holding for additional few months will alleviate this. So at the end of the day, it depends on how conservative you are. If you can't stand to see their investment lose even a few pennies of value, then a money market fund is the only answer that is acceptable, because you are going to have those fluctuations, as we mentioned earlier. And this is going to account for what the current interest rates are for the treasury bonds, as well as paying out the dividend. Because every time it pays out that dividend, it's going to drop back down to the amount prior. And that's common for a lot of dividend paying stocks and ETFs. You're always going to see the ETF or stock drop by the dividend amount on the EX date. So let's give an example scenario of someone who may have quote unquote lost money. So someone may have bought on August 26th at a price of $100.66, and then they sell on September 3rd at $100.40. Now, on paper, that person may have lost money, but you're not accounting for the 36-cent dividend that you're receiving. So you will have a capital loss temporarily on the share price itself, but if you factor in the total returns with that 36-cent distribution, you're going to be out positive instead. And if you're still confused with this, let me know down in the comments. You pretty much can't lose money with SGOV. It's very safe and it's a great place to store your emergency fund. But I recently just moved my entire emergency fund into this cash sweep account with Moomoo. As we can see, we have $20,000 and I've held it for a little over a month now, and I've made over $167 in interest alone. And why exactly did I move it into this account? Well, you're actually going to be getting an 8.1% APY for 3 months just by signing up for Moomoo. Link is down in the description and in the pinned comment below. In addition to that 8.1% APY, you're going to get up to $1,000 in NVIDIA stock. Now we can take a look at the welcome bonus. If you deposit $100, you're going to get $20 of NVIDIA stock. $2,000 gets you $50 of NVIDIA, and a $10,000 gets you $300 of NVIDIA. Depositing over $50,000, you're going to get $1,000 of NVIDIA stock. Now, there is a waiting period. You do have to deposit, have that cash balance maintained for a certain period of time before these bonuses are released to you. But this is a great way to earn some extra cash on your already uninvested cash. And we can see once this 8.1% APY ends, you're also going to be getting a 4.1% APY, which is the normal cash sweep rate, which is absolutely amazing. And it's a lot higher than other brokerages or money market funds. But for now, you're going to get 3 months of 8.1% APY. You can deposit your funds. You can leave it there for 3 months and withdraw it or do whatever you want after the end of those 3 months. But for now, I am keeping my entire emergency fund into this account, and it's been earning interest very nicely. And once again, the link is in the description and the pinned comment below. This is literally free money. Now, next up, we have Roundhill Investments Week, which is the weekly T-bill ETF. And this is a lot different than the other ETF, SGOV, because you're going to be getting weekly distributions, and it's also going to invest in short-term US Treasury bills. So why week? Why would you choose week? WEEK is a ticker. We can see it's going to pay out weekly distributions, and that is going to be the main draw to WEEK. It is going to have a slightly lower distribution rate in exchange for more frequent payouts, which some people may prefer. Because if you're getting cash sooner, you can utilize that cash earlier for whatever bills, or if you just want to reinvest it back into this ETF, you can as well. And it's a cash-like alternative. It provides exposure to US Treasury bills with maturities between 0 to 3 months, providing an attractive vehicle for investors seeking capital preservation. And you're also going to have a stable NAV, which SGOV is also very stable week over week. Now, because it does do weekly distributions, you are going to have a little bit more stable of a NAV because those dividends on the ex-dividend date, it's not going to drop and rise as much. And that may be a lot better for a lot of people if they don't want to see huge penny swings in the share price. They want something that stays as flat as possible. Week is going to do that. We can see it's been paying out since March of 2025. So it's only been out for a few months now, but it's been paying out pretty consistently. We can see it's been paying out between 6 cents and almost 8 cents per share every single week, pretty much 7 cents to 8 cents. So it's very consistent. You know what you're getting. And these ETFs, as a reminder, they're not going to make you rich. It's a place to store your emergency fund, store extra cash for taxes that you've set aside, or any cash you want for short term purchases, or even any uninvested cash that you may be using in the near future. And then next up, we have NEOS ETFs with CSHI, CASHI. So this is going to be the NEOS Enhanced Income 1 to 3 month T-bill ETF. Now this is different than the other two ETFs, which were 0 to 3 months. This one is going to be 1 to 3 months. So it does have a little bit longer of a time frame maturity for the T-bills, but it should not matter too much. Now what you're going to be getting with CTF is monthly distributions, about around a little bit over 5% distribution rate, so a lot higher than SGOV and WEEK, but you are going to have a higher expense ratio at 0.38%. We also do want to mention that week has an expense ratio of 0.19%. And that is why I love SGOV so much. It has the lowest expense ratio at 0.09%. Now, what are the benefits of CSHI? So the fund is going to seek to distribute monthly income generated from 1 to 3 month treasury bills. And here's where it differs, is implementing a data-driven put option strategy. It's going to be actively managed by NEOS, hence the higher expense ratio. And it's also going to seek to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which is going to be subject to the lower 60/40 tax rates. And I do want to mention that WEEK as well as SGOV are not subject to state taxes on the distributions because it's holding treasury bills. But because CASHI is utilizing some option strategy on top of the treasuries, you are going to have a little bit higher of a tax bill because of that. But they're doing it in a very efficient way. It's going to be 60% long-term capital gains, 40% short-term capital gains for those contracts. And this is NEOS that we're talking about. Famous for SPY and QQQI, they also have BTCI and a lot of other great ETFs. A lot of people love them for its stability, its reliability, and its tax treatment. So if we take a look at CHSI, we can actually see it's been out for quite some time now, since September of 2022, and it's been pretty much stable around the $50 price range. Now we did have this drop around Liberation Day, but it recovered very nicely, and we're back up in the $50 price range. And I know a lot of people are a huge fan of these ETF because you are getting 1% more than SGOV. It's going to be a little over 5% distribution rate, and it's been very reliable with its dividend payouts as well. So those are going to be 3 options where you can store your emergency fund or just put your cash in any uninvested cash. Now let's compare the returns of SGOV, WEK, and CSHI. So we can see year to date, SGOV has 3%, WEEK has 2.22%. That one is not very fair because it's only been out since March, so it's not accurate. CSHI as 3.49%. So we can see, of course, CSHI is beating SGOV by a little bit. Now, if we compare the overall return, and this is comparing it from March 6th, when WEK was created, to now. So SGOV is going to be 2.22%, WEEK 2.22% as well, and CSHI at 2.82%. Now, if you're okay with a little bit more of fluctuations, CSHI is your best bet. If you want to stick with the tried and true, one that's been out forever, SGOV is going to be your best bet. It's going to be 2.22%. And what's interesting is it has the same total return as WEEK, mainly because WEK pays out weekly distributions, which means you're going to be reinvesting your dividends much sooner than SGOV, which is going to help snowball the compounding effect a little bit more. So it's actually on par with SGOV, and that's very surprising to see. So actually, a lot of people are a huge fan of WEK for that reason. It's performing pretty much the same as SGOV, and it pays out more frequently. But you can't go wrong with SGOV or WEK or even CSHI for that matter. If you want a little bit more of some juice, that is a great alternative as well. But of course, Moomoo, link in the description and pinned comment, has an 8.1% APY for 3 months. You can deposit your cash, you can withdraw it if you want, but I'm earning a ton of interest on my emergency fund in the meantime. And after it's all done, after that booster is all done, you're going to get a 4.1% APY. And my plan is I'm probably going to move it back into SGOV or even CSHI. Seems like a very favorable option right now. So let me know down in the comments, where are you keeping your uninvested cash? I know there's a lot of great money market funds out there, but are you investing in SGOV, WEK, or CSHI? And let me know in the comments if there's any other alternatives that you have seen.